Hello everyone and welcome to your Glassnode video report for week 44. I'm your host Checkmate and we're recording on the 2nd of November 2021. So the market has really consolidated down here around this. It's ducked down to about 58,000, but really it's traded for most of the week around the 60 to 62,000 range. So this is quite impressive considering how much strength we've seen in the market rally from October. That October candle itself, the total range, if we include the wicks, was actually a $23,205 candle, which in context, Bitcoin only hit 20,000 after multiple years trading from essentially from Genesis through to 2017. We then had the entire market from 2018 through 2019, 20, and it was only in December 2020 that we actually got to $23,200. So essentially from Genesis all the way through to December 2020, that entire price range is the same size in price trading range as October's candle. So it kind of shows you just the absolute scale of what happened. And then to see the consolidation, we're really holding, the market is holding its ground up here. So that's really what we're going to assess, is this kind of in-between balance where the market's really consolidating, trading sideways, and we're going to be looking at the different components of the market to just understand if there's any kind of headwinds or if it's all looking relatively healthy. So we'll look at things like the patterns of spending in metrics like SOPR, which really tells us about the profitability, the loss, and whether we're getting this kind of return of conviction to the market. Are we seeing this bounce where profitable coins stop being spent, losses get realized to a little extent, and then we start to see the market push forward? We're going to look at things like our funding rates, which are cooling down. Are we starting to see any of the leverage starting to creep back into the market? What's the quality of that leverage? And we're also going to look at a couple of metrics relating to HODLing and how the lifespan metrics in particular, because we use lifespan as a key input to understand what the smart money and the long-term holders are doing. How are these metrics performing? What does it look like over the last couple of months? And are we seeing a mass exit of these spenders, or is it overall looking fairly constructive? So let's jump into the charts and we'll start our analysis. So as we mentioned, we've had a very, very strong week this week. We're consolidating. We hit our $66,000 all-time high around the 20th of October. And this week we traded somewhere between 64,000 down to 58,200. So we're really seeing this very, very strong consolidation. It's really painting up what looks to be a bull flag. We even saw Ethereum hit an all-time high of 4,400 this week. So overall, the market is looking relatively strong. Price action continues to be a relatively constructive metric. Now, when we look at things like our spending behavior, when we look across all of these metrics, as price rises, the incentive to sell also increases. Now, that's okay. We're always going to have some people who are selling. There's a price for every hodler. What we're really looking at is what's the quality of the spending? Are we seeing a huge portion of the market selling? Are we seeing coins that were purchased back at $200 exiting? Or are we looking at just general day-to-day spending? So there's a few things we can look at here, and I've got the metrics I'm particularly going to look at are the adjusted SOPR and the short-term holder profit and loss ratio, which are telling a fairly similar concept. On the left, so adjusted SOPR, you can think about the axis here between 1, 1.1, 1.2. If we look at all of the market, and we exclude transactions that are younger than 1 hour, because they're generally relays. They're going from an address to an address, and then they're being respent. So it's kind of like there's an intermediate. We discard those younger than 1 hour transactions. So once we've done that filtering, what we care about is it realizing a 10% profit, a 20% profit, a 90% profit, which is actually a 10% loss. So we look at all of the coins that are being spent, excluding 1 hours. What is the overall profitability of them? So during bull markets, we see these uptrends, higher and higher profits realized. Eventually a top gets put in and we get a correction. During that correction, what we want to see is profitable coins stop being spent. So the metric will pull down, because if profitable coins are spent, it will trend higher. And some of those folks who bought the top will eventually capitulate at the bottom of a capitulation event. And that's generally a good signal that we're actually going to get some kind of bounce. It's kind of this counter trading concept. Now, what have we seen over the last couple of weeks? We've seen this gradual rise higher, so more profits are realized as the market rallied from September through October. We've then seen a pullback, and we've seen 1, 2 retests slightly below a value of 1.99. So that means that a couple of people were realizing losses at the bottom, and we've since seen a bounce from that point on. Now, a bounce where price rallies higher and we get more profits being realized is telling us something about demand. someone has to step in and buy those coins. And even though there's profits being realized, there's enough demand to step in and actually push price higher. So overall, this is looking relatively constructive. And this is a really, really nice, almost a textbook SOPR reset. Now, again, what would trigger us to flip our mind on this? If this happened to break down below and we started getting some fairly bearish price action and people started realizing losses and the market was unable to sustain it, then it starts to look something close to what we had back here in May and June, July. That's a less positive, less constructive type structure. Now, we can see a similar thing on our short-term hold-up profit-loss ratio, which is a very similar concept, but it's only looking at the short-term holders in the network and overall, are they realizing profits or loss? Now, what we can see is that during bull markets, right, here's 2020 and into 2021, they are primarily realizing profits. We can see that the majority of their spending is realizing some kind of gain. As we started to shift into the sell-off in May, it transitioned into a very deep and lengthy period of losses. So we were seeing a negative value or a value that's less than 1. Significant values of losses were being realized, which is telling us it looks more like a capitulation event. Now, what you can also see is that in each of these market corrections, we tend to get these reset values where it pulls back, bounces, pulls back, and bounces. Again, this is showing that people who hold profitable coins are less likely to be spending them, and that's showing that there's conviction return to the market. Now, after the major capitulation event, you can see the depth of this relative to in July, relative to May and June, we then had a bounce back. The market was a little bit uncertain through August. There was a couple of profits being realized, but overall it was a little bit uncertain, fell back down below, and then we got a very, very strong push up through October. Now, this is showing us that profits were realized and the market pushed on, that there was sufficient demand to absorb that sell side. Now, we haven't quite got a full reset yet. We're here about 4.5, but note that this is not too dissimilar. 4.3, 4.2, 1.7, 3.3, 3.8. It's not too dissimilar to what we've seen in the past. So yes, it could suggest that we have a little bit further to go to get that full reset. Some of those short-term holders who bought the exact all-time high may need to capitulate to a lower level. This is very possible. So it could tell us that there's a little bit more time left in the consolidation tank, but overall, it's looking relatively constructive, and this slowdown in profitable spending as the market corrects is generally a fairly constructive sign. So now we're going to look at long-term holders because they're kind of the other side of this equation. That was more shorter-term spending. Now, the long-term holder NUPL, or net unrealized profit and loss, what this metric is telling us is something about the unrealized gains. For every coin, we can assess the price when it was withdrawn from an exchange. We can look at the current price and say, is it currently in profit or is it in a loss? So where we are currently sitting is at a value of about 0.7. So that's showing that 70% of the market cap is held by long-term holders that is in an unrealized profit. Now, what we can also see is that during these macro tops, we can actually trade at very, very high values marked in this blue zone, which is generally what we classify as a macro topping pattern. It can generally hold and sustain those levels for some time. Now, what this is generally saying is that long-term holders, when they enter profit, they're more likely, once they're in the green, they're more likely to sit tight and allow the market to play out. And they may well be waiting for higher prices to actually liquidate. So what it's telling us is a little bit about the unrealized gain. And naturally, as the market continues to rally, it starts to show that the incentive is increasing, the probability of them spending is going up, and therefore there's potential sell side. Now, one thing that is important to note is that we are actually at or just above the price we were back here when it was blue. And this was at 0.9. So that's showing that 90% of the market cap is profitable. Now, where we are here, you can see that we're actually at a much lower level. This is because we've had long-term holders who have been shaken out. We've had long-term holders who actually accumulated during this topping pattern and it's brought down their overall unrealized gains. We've had long-term holders who recently bought this dip back here and are starting to transition into that long-term holder status. There's almost been a shuffling of the cards. Long-term holders have kind of renegotiated where their positions are, and they're now sitting in the market is essentially semi-restructured, and people's cost basis has been brought down relative to the current price. You can almost think about this like a fuel gauge. We're still sitting at a, it's starting to get closer to empty, right? This is what empty would look like when there's just too much profit on the table and people eventually start selling. Right now, we're not quite at empty, we've actually recharged some of that fuel tank, even though our price is at a higher level. So this is just something nice to take away. You can kind of see that long-term holders are actually in a bit of a healthier position. There's a little bit less greed in the market in that sense. And we haven't quite hit the level where we traditionally start seeing a large amount of long-term holder spending and eventually putting in that macro top. Now, our long-term holder SOPR, this metric, whereas our short-term holder and our adjusted SOPR tend to trade between these bounds of 0.8 and 1.2, long-term holder SOPR, you can see, has these much larger increments. We're getting these whole numbers, 2, 4, 6, 8, 10. That's showing that they're realizing profit multiples of 200%, 400%, 600%. The longer that these people are sitting in the market, the higher the overall gains they're realizing are. And note that as price has rallied, let's actually zoom into our current market cycle. Note how we had this reset. It's very, very rare that we get this reset of long-term holder SOPR back down to 1. And note how it occurred exactly on the bottom here in September. So what we actually had is a beautiful reset back down to 1, almost a retest, and we've essentially started trading higher from there. Now note that we normally get rising long-term holder SOPR, higher profit multiples as the market rallies. And this is just simply the fact that the longer that these people stay in the market, the longer that coins are dormant, the higher the probability, and as price rallies, the higher the profit multiple that can be realized. Now, we saw a fairly significant print over the last couple of weeks, which actually shows that some of these older coins, these ones that are in a higher profit multiple, have actually started to be realized, right? Profits are being realized. We get this increased spike. This got up to 5.1, so that's a 500% over the course of the entire market, 500% average profit realized, which is fairly healthy. But note that price has traded more or less sideways. So even though overall, the market of long-term holders on this particular day realized 500% profits, the market traded sideways and essentially absorbed that sell side, which is showing us that there's enough demand to absorb that sell side. So at the moment, this is actually, by and large, across all these metrics, it's actually looking very, very constructive in my opinion. Now, if we then move to the derivatives market, so this is where we can generally get a bit of a short-term headwind. If you get too many people leaning on the wrong side of the boat, it can lead to somewhat of a flush out. Now, we spoke about this over the last couple of weeks. What's important here is we're seeing, here's our perpetual funding rate. So remember, this is the interest rate that people are paying to be long if it's positive and green, or short if it's red, paying for the other side of the trade. So it's basically the privilege of taking on that leverage position. Now, note how we get these huge spikes. This was the 66,000 all-time high. We regularly get these high spikes in funding. Everybody goes long, and then the market decides to essentially punish them and pull back. Now, what we also generally see is these long liquidations, right? Here's our all-time high, and here's our total long liquidations. Note that our funding rate went fully positive at the 66,000 all-time high, and we swiftly flushed that out, and we had a huge amount, $87 million worth of longs got liquidated within that particular day. So it kind of shows that this is the market self-correcting. When too many people are leaning on the wrong side of the boat, we do tend to get these flush outs. Now, note also that we have our percent futures that are crypto margined. Now, this is a really important metric and describes the health of the overall derivatives. Now, if you take on a futures contract and leverage, and you back that with a volatile asset like Bitcoin, then essentially you're compounding your risk, because if the price falls and you're long, then your future can get liquidated, but your collateral is also moving with that same price. So the value of your collateral that's backing your already volatile leverage long position, it's volatility multiplied by volatility. Now, note that as we're trading at a very similar price to where we were back here in April, note that back here we had 70% of all futures were backed by crypto. Now we're down to 45%. Most of it is now backed by fiat or stable coins. This is essentially the removal of a very, very large part of compounding risk, which is overall an extremely healthy position. It's showing the market is maturing, and it's showing that even though we may have slightly higher funding rates, but note it has actually pulled back recently, which is healthy. But even when we do have high funding rates, the quality of margin is far superior. And even though we had $87 million worth of longs that were liquidated, note that what we didn't have was a May 15th type period where it's a 50% candle down in a single day. So we're not seeing the same kind of liquidations that are happening because it's this cascading long liquidations and stop losses are hit and then margin gets liquidated. We're not seeing that to the same extent, which again is demonstrating that higher maturity, higher quality of asset, and overall just a superior setup for the market at the moment. So lastly, we're going to focus on spending behavior. This is back into the on-chain space. Now, what we care about when we're looking at lifespan is one of the most, I'm going to say nuanced, but useful tools in on-chain analysis. We use lifespan as a proxy for smart money, for want of a better term. So the longer that a coin is dormant, statistically speaking, the more likely it is to stay dormant. So what we're saying there is that when a coin comes out from an exchange, it is highly probable that a candle will come where, market trades up 20%, market trades down 15%, and the person who recently withdrew goes, you know what, I'm going to take profits or I'm going to take the loss. People are more likely to react with recency bias. The more recently a coin was withdrawn, the more likely it is to be respent. And we can see this. Note how the yellow, this is less than 1 hour, and then this dark yellow is 1 hour to 24 hour. Note how these fill up. This is the spent volume age band. So of all the BTC volume spent that day, how much of it was of each particular age? And note that our less than 1 day, right? All of these two yellow bands fills up. This is the 20% marker here, fills up somewhere between 80% and sometimes down to 95% of the total volume that's being spent. The vast majority of coins that are on the move are actually very, very young. So this is telling us something about the overall market dynamic. So let's take the opposite side of that debate. If the coins that are recently withdrawn are the most likely to react to volatility, then somebody who bought their coin at $200 probably doesn't care that much where price goes from 60 to 61 to 59. It's far less consequential for them because their cost base is so far away and the time since they last accumulated that coin is more or less insignificant. So it's that kind of opposite type effect. So what we look at with lifespan, here's a good example during our bull market in late 2020, early 2021. Note how these purple bands started to come back to life. These are older coins being spent. It's showing that a larger proportion of the volume was made up of these 6 month, 12 month, 2 year, 1 year, 5 year old coins, right? We're seeing these coins come back to life, taking profits. February was the peak. We had our correction. We had a kind of sustained spending pattern. But then note how during our correction from May through to July, most of that, note how much purple is here. Note how it really died off. It became these orange bands, right? These are relatively young coins. These were top buyers, right? A couple of months, 2, 3, 4 months, they're spending their coins down here. And who do you think is accumulating? The same people who were liquidating on the way up, right? We used lifespan to try and judge smart money, new money, and trying to understand how these different cohorts behave. So where we are at the moment, we can see we've got a couple of these older coins that were spent, but note that price again, trading sideways. Again, spending is good. It's good to see distribution because it's telling us that there's something about demand. When somebody is selling, there's a buyer on the other side of that transaction. So spending is very, very normal. It's part of a bull market. But what we actually care about is it overwhelming demand? And when we see price trading more or less sideways or in a very healthy bull flag consolidation, even with a bit of spending going on, that's still a healthy signal. So we have to look at all of these things in balance. So lastly, we're going to look at 4 lifespan metrics. So I will regularly use these 4 in combination. And to be honest, they're some of my favorite metrics because they just tell such a simple story and they look at it from a few different angles. So all of them concentrate on destroyed lifespan. If a half BTC has been held for 1 year, because 1 BTC would have accumulated 365 coin days. If it's then spent, it will spend and destroy that 365 coin days, reset back down to 0 and start reaccumulating. If it's half a BTC, it will have accumulated half that many coin days, destroy half as many, and then reset to 0. So it's coin volume multiplied by how old the coin is since it last moved. So when we look at things like average spent output lifespan or ASOL, we're looking at the per UTXO. Right, so of all the coins that were spent, we don't care about the BTC volume, we just care about how old the UTXO was. What is the average age, right? So naturally, higher ages means more older coins are being spent, and we see this in bulls. Lower values or downtrends means that the average age of spent outputs is decreasing, and that's normally showing some kind of accumulation type behavior. Average coin dormancy then looks at the average age per unit BTC. So in this instance, if it's a value of 40, that's 40 days per BTC, per 1 unit of BTC. So average coin dormancy is very good for when you're looking at a high volume environment. We're seeing lots and lots of coins moving around. Dormancy is going to give you a really nice view. ASOL is good when you've got a very quiet mempool, which is what we saw back here in May through to July. When there's very, very few transactions, obviously there's very little BTC moving. And that can therefore disrupt, particularly Coindays Destroyed or Dormancy. ASOL is kind of an all-weather tool, but it lacks some of the nuance of BTC volume. Dormancy includes BTC volume, but it needs a little bit of, in low transaction environments, just needs a little bit of attention there. Coindays Destroyed is kind of the raw value. How many Coindays were destroyed? We're not dividing it by BTC volume to get dormancy. We're not ignoring the total amount of BTC volume to get ASOL. Coindays Destroyed is just the raw, did we destroy 20 million Coindays, 10 million Coindays, so on and so forth. Now, if we look at Coindays Destroyed over a very long period of time, what we kind of care about is, was it above average or below average at the moment? And that's where we get binary Coindays Destroyed. If more than average were destroyed, then we get a 1 and we get a solid bar. Note we get these solid bars during bulls where lots of Coindays are being destroyed, and they open up during bear markets or accumulation periods when few, it's less than average. We're seeing less than average Coindays destroyed. We're starting to get a little bit of a closer, but again, this closing up here is mapped onto these coins. So we can actually see these, and we know that price went sideways, which is healthy. Average coin dormancy is ticking higher. But again, it aligns with this metric here, where we're seeing that there's more coins being spent, but the market is absorbing it. Also note that this is our pre-bull period, right? 20 days or so. This is what we saw all the way through 2020. Note that we're really not that much higher than where we were before. This is what bull market distribution looks like. This is the early phase of bull market distribution, right? ASOL is actually pulling back somewhat, so that's showing that on a per UTXO basis, we're actually seeing a younger overall coin age, but that also means that we're seeing fewer UTXOs, but more coin volume. So of the old coin volume that's moving, there's not many of them, but there's more coins inside them. So it's showing that there's fewer spenders, but spending larger volume. It kind of signifies maybe it's discrete actors rather than a mass exit of long-term holders. And Coindays Destroyed is going to reflect closer to average coin dormancy than ASOL. So overall, what we're seeing, if I was going to summarize everything we've looked at today, on the derivative space, we still have a net long. People are net long, and that can create a headwind. But simultaneously, the quality of the leverage is far superior. It is a better leverage than what we saw this time in April. In terms of the overall spending behavior, we've had a beautiful reset of the SOPR metric. This is very, very constructive and normally is a nice sign for a bounce from that point onwards. And we are also seeing some spending going on from long-term holders, but that's okay because the market is essentially absorbing that without too much of an issue. On our binary Coindays Destroyed, it's still relatively gapped up. This is what a bull market distribution looks like, and we are nowhere near that just yet. So the spending is kind of discrete. And it so far hasn't really put in enough coin volume to slow the market. We're continuing to trend sideways, so it's showing that the demand remains sufficient to actually hold that spending. So thanks for tuning in. I hope you found this video useful, and particularly going through lifespan metrics in a bit more detail. I'll try and focus on a couple of these in each session just to really help you explore and understand how to use them, especially in context. Do give us a rate, review, and a subscribe, and I will look forward to seeing you in the next one. Cheers.